In a week that was supposed to see inflation data out of the US that by and large would have headed up proceedings, we of course continue to see a data blackout thanks to the ongoing shutdown. And even when we do see that resolved, there's question marks over the validity of the data anyway. And instead, this week we can focus on jobs data coming out of the likes of the UK and Australia, alongside earnings season, which continues to rumble on after a particularly volatile and interesting week just gone. So, as we see here, this is the sort of breakdown for the events in the coming week from a sort of top ticket perspective, so to speak. Now, I think really, like I was saying, when you're looking at the sort of US perspective, you need to bear in mind that much of the data, even when we do see it, so when we see a breakthrough in terms of a potential end to the shutdown, much of the data is maybe going to be irrelevant because some of it is collected over the course of a month, and therefore if you don't have that process in place, how can that be compared to the previous ones that have been collated? Otherwise, if you've got sentiment data, how is that going to come forward if you're asking someone how they felt or how the market conditions were, say, a month ago? There's big question marks around the US data. So instead, we're going to be looking here at data from elsewhere around the world. You can see on Monday and Tuesday, we've got Australian data in terms of consumer confidence and business confidence. We've got the jobs report out of the UK on Tuesday, ZEW economic sentiment out of Germany on Tuesday as well. Then a continued focus on the UK with a raft of data on Thursday morning, headed up, of course, by the GDP numbers, but we've also got the likes of industrial production, manufacturing production, trade data, and then rounding things off on Friday, industrial production, retail sales, amongst other releases coming out of China. So we're going to kick off with the UK. Like I said, essentially Tuesday and Thursday provides a raft of data points coming out. This comes hot off the heels of the latest Bank of England rate decision that saw the likes of Andrew Bailey and co keep rates steady at 4%. And the key thing really is that we saw the vote coming in at 4-5. Essentially 4 out of the 9 members voted for a rate cut. So razor thin is as tight as it could be. The casting vote came from Bailey, who opted to pause. But essentially that really puts us in a position where it looks very likely we're going to see a rate cut in December. Now, what would push us further in that direction? Well, it would be the deterioration in terms of the UK jobs market and the continuation of relatively controlled inflation. You can see here the forecast here is actually for a weaker unemployment rate. This comes off the back of a period of upside in terms of unemployment. And then the claimant count also a weaker figure, but a positive figure nonetheless. If we look on to Thursday, you can see GDP for the quarter for Q3 is expected to come in at 0.3 again. That takes the year-on-year figure up to 1.3, if that's exactly how it comes out. We also see the monthly, which is a 0.2 expectation, so an uptick from the previous figure. And then the likes of industrial production, manufacturing production, both expected to be positive year-on-year figures. So by and large, markets are expecting a relatively upbeat week of data in terms of lower unemployment, lower claimant count, higher GDP, higher industrial production, manufacturing production. And so, of course, that could potentially feed into a narrative around the UK possibly looking in not too bad shape, and that maybe the Bank of England needs to hold off. But that being said, I don't necessarily think that there's going to be too much of that, because of course we do also have the upcoming budget out of the UK. That budget is expected to bring increased income taxes, or at least increased taxes somewhere in the economy. Certainly there's been speculation that's rife that it could come on the income tax thresholds. And of course that has a downward pressure on growth and potentially an upward pressure on inflation. So certainly that's going to be absolutely key. But this coming week ahead, if we see underperformance compared to these figures that are expected, so markets expect improvement across a number of these metrics, well, if we don't manage to do that, then that could shift things onto a more pessimistic tone. You can see here in terms of the jobs market, we have seen that uplift in terms of unemployment, but also the rise in terms of the claimant count at last release. So that's expected to remain in positive territory but moderate a little. In terms of the GDP numbers, you can see here sort of fairly minimal figures over the course of the past 2 months, but we're expecting to see a push higher in terms of that number. So all in all, if you look over the course of the past 4 months, it's not necessarily been too shabby, and that is sort of evidenced by the 3-month average. Here we go here. So the 3-month average, 0.3, it's not too bad really if it comes in that way. In terms of market expectations, right now, according to the Icon platform, you've got 56% chance of a cut. I think, we're just a couple hours after the Bank of England rate decision here. So I think that will probably adjust a little bit more over time. Nonetheless, I think it's very likely that we do see that rate cut, in particular because of the fact that inflation has appeared to be relatively under control over the course of the past 5 months. But there's a major hurdle up ahead that comes in the form of the budget, and therefore what happens in that December meeting, a lot of it's going to come down to how that budget comes out and whether we see significant tax hikes that is perceived to be inflationary by nature. Let's just jump onto the charts and show you euro sterling. It's one of the charts that I have sort of followed very closely over recent months from a sort of daily perspective. Let's just look at it. So the daily chart shows you this very bullish trend, and I've been sort of guiding you guys through this. Now more recently, you can see on the short term this little pullback that we saw in the lead up to the the Bank of England meeting. Now in the immediate aftermath, you can see that we did actually pop up through this 881 resistance level, but now started to weaken a little bit. Ultimately, this 50% ratio, or this Fibonacci level, has held thus far, and we have got this ascending trend line, or at least a sort of preliminary trend line, because we haven't got the third touch. I think there's a very good chance that what we're seeing at the moment in terms of downside is essentially a precursor to the bulls coming back into play. That rise through 881 did look like the signal that essentially that bullish rebound and continuation move is happening now. We are seeing this little bit of a retracement though. So do we see a deeper pullback coming into the 4 here? I personally don't think that's going to happen. I might be wrong, and certainly this could be proven wrong in the next couple of hours. But, I think there's a good chance that we've hit a low here, considering the rally that we've seen up through resistance. So, if we hold and we don't break through the sort of 0.88 kind of area, 0.89, 879, then there's a good chance that we start to base from here. Of course, there is a risk that we do retrace a little bit more, and in which case you'd be looking at a scenario where you possibly come into a deeper Fibonacci zone. But as long as we don't break the 0.876 level, this pullback that we're seeing at the moment looks like a likely retracement. And as things stand, it also looks like a likely ABC style retracement as well, which is how I prefer these things to play out, which would be first leg, second leg, and then we're in the third leg. You don't necessarily know, it could get deeper, it could just be done here. Like I said, that rally up through your first resistance level would signal the high possibility that we are done with the retracement zone and that the bulls are back into play here. And certainly if we see data that comes out relatively weak compared to expectations, then you're looking at the high likeliness that we do see euro sterling on the front foot once again. Next up, let's look at Australia. We can see the Australian data released over the course of the week really focuses on the jobs report on Thursday. This also comes off the back of a rate decision from the RBA in the week just gone. We saw them keep rates steady as expected, and that comes hot off the heels of a recent inflation gauge that did surge unexpectedly and really sort of put the mockers on the idea that we're going to see further easing over the near term from the RBA. Well, this week gives us the opportunity to see whether we're seeing any pressure building. And you can see in terms of inflation expectations, that actually is forecast to drop, but 4.5% is still well above that 2 to 3% target band currently in play for the RBA. Now, employment change expected to rise, unemployment rate expected to decline. So much like the UK, it's expected to come out with relatively positive updates over the course of the week. Now, This is the inflation sort of surge that we have seen in terms of the quarterly figure released recently. So there's question marks here as to whether we are now starting to see a resurgence in terms of price pressures. And so, the dual side of things means, how's the jobs market looking? How's the inflation picture looking? And how will rates sort of adjust to that? You can see in terms of the unemployment rate, we have been on this resurgence of late in terms of unemployment, but still from a historical perspective, it's very low, as you can see, lower than the levels before the pandemic. Now, in terms of the RBA rates, you can see here that markets aren't expecting much from the RBA going forward, because if you look to the back end of 2026, we're only one rate cut away from where we are at the moment. And that highlights the fact that, in actual fact, people are now fearing that we could be as likely to see the next move as a rate hike as a rate cut. So there's a lot of question marks in play here, and that provides potential strength for the Australian dollar. We can see in terms of the Aussie here, let me just jump onto that, against the New Zealand dollar. You can see that we've been on this massive ramp up of late. Now, crucially, this is a pair that I was talking about last week. We rallied up through this resistance level in play here since 2022, and you can see it also tallies up with, there you go. Oh, let's try and snag that perfectly on the top. There we go. So we've got this resistance level that essentially highlights the range that's been in play since 2013, right? So are we bottoming out here? Have we finally broken that range, and are we now set on a new pathway higher for the Aussie against the Kiwi? Well, certainly worth watching out for and keeping a close eye out on to see whether that is the case. We can see here in terms of recent upwards trajectory, trying to speak and draw at the same time, you can see that we're currently breaking through support. So certainly if we were to start breaking down through your nearest term swing low, which is 1148, then it paints a picture of a potential retracement phase coming into play, notably potentially sending us back down into that zone of those historic peaks that you can see just down here. But certainly, if this is a week that gives us cause for optimism around the Australian economy, and therefore takes some of the pressure off the RBA when it comes to them needing to act, given the recent inflation gauge, that would point towards the possibility of further strength for the Aussie dollar. We have come off the back of a rampant rise higher recently, really, so I wouldn't be surprised at some point to come into a retracement phase. Does that happen here or not? That remains to be seen. But certainly this is going to be a really key market to be watching out for, given the recent break that we've seen up through these big resistance levels that have taken us into the highest level since 2013. Then finally, I just wanted to touch on what's happening in terms of earnings season. This is the breakdown for the... That's the wrong one. There you go. This is the breakdown for the earnings in the week ahead. You can see headed up by Cisco at the top of the pile. Certainly a tech stock that's come back into the mainstream sort of psyche, really, with that deal with the US government. Then we've got Walt Disney, Applied Materials, Brookfield, Sea Limited, New Holdings, and the list goes on towards the bottom. Let me just grab up a couple of charts for some of these, and we'll look at it from there. So let me just also show you this, which is the wisdom tree breakdown of exactly how things have happened thus far. You can see 412. This is as of the 6th of November that I bring this data to you. As of the Thursday, essentially, we've got 412 of 500 S&P 500 stocks having reported. That's 80% by weighting. And if you're looking in terms of the wider picture, in terms of growth, earnings growth 14.3%. So it's been a really impressive time, that's for sure. You can see the breakdown in terms of which sectors are doing particularly well and which aren't. Of course, the standout remains the tech space, but that doesn't necessarily mean all those tech companies are doing incredibly well from a share price perspective, because what we've seen over the course of the past week is that many people sold stocks that have just reported some really healthy figures because there's constant question marks around overvaluations. We've also seen strength in terms of the financials, the industrials, and the materials and the utility space. So much of the S&P 500 doing very well in my mind. If we're looking in terms of the sort of top two that are reporting in the week ahead, we're going to be talking about the likes of Cisco and the likes of Walt Disney. So from Cisco, you can see here from a weekly time frame, we've seen this really strong surge of late. That now is being sold into in a pretty meaningful manner. But in my mind, I think, as would be the case with much of the tech sector, the weakness we're seeing over the short term is likely to be a short-term reprieve. I don't necessarily think that the sort of rally is over, and therefore this near-term pullback is likely to be an opportunity rather than a sign of a top. Quite how deep we go in this pathway remains to be seen, but essentially from my perspective, I see this as a likely retracement phase before we turn higher once again. That means to the downside, you'll be looking at support levels at 70.8, 69.8 and 68.7. From a Fibonacci perspective, you can just look at it from a sort of short-term perspective and look at it on, say, the hourly and say, well, we've now set this new swing high. So if we break through to 72.6, then that's my signal that this sell-off is over. Different ways of looking at it, but essentially from my perspective, I think this is likely to be a short-term period of weakness before the bulls come back into play, particularly in the back end of November, because November is historically, from a seasonality perspective, a strong month for the S&P 500, but generally it sort of underperforms in the first week, which is exactly what we're seeing at the moment. So Cisco turning lower, but I think the trend still remains bullish, and therefore unless we break the 66.80 level, then this pullback looks likely to be a short-term reprieve. Then looking at Walt Disney, things looking a little bit different from this perspective. Certainly you can see that we've been caught in this range essentially over recent years. Certainly there is a feeling that this is a company that really suffered thanks to the pandemic, and with the question marks at the moment around, say, jobs and things like that in the US economy, there's of course going to be question marks around demand for what is a relatively luxury good for much of their products. Now you can see here also that price has been rolling over. So you could say, well, this is a shallow retracement and therefore it's a likely precursor to the recent bullish run coming back into play. You could say this is a falling wedge formation and therefore this is going to be a precursor to the bulls breaking out. But essentially, from my mind, I think this range still remains in play. We've just hit resistance and now we've been heading lower ever since. So I think there's a good chance that we continue on this vein. Certainly, if we do break out through trendline resistance and break up through your near-term swing high, which is currently 114.53, then things start to look a little bit more different over the near term. But until that happens, I think it's likely that we continue on this vein and the bears still remain in charge in the lead up to a key earnings report for this company. I hope that's been useful. Make sure to like, subscribe and follow for more. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and a great week ahead.